Next question is from Puvan. His question is, I'm keen to understand how to move one member of an SMSF from accumulation phase to a benefit paying phase while the remaining members continue in the accumulation phase. So my specific questions are, does the ATO need to be informed of the change status of the member going from accumulation to benefit paying phase? If so, how is the fund to inform the ATO? Question 2, I've seen literature that suggests an actuarial certificate is required to achieve point 1. Why is this the case and what will the certificate cover? And the third point is, what other parties need to be informed of the change in the member's status?
Again, look, another really good question. It's interesting that a lot of the questions this month we've received are around pension starting. So lots of people looking to start pensions inside their super. So I'm not sure if that is across the board, but it was obviously a key flavour of the questions that we got. All right, let me have a look at some of the important issues that we need to think about here. And it's probably no doubt what I'll say first. Always check the specific rules of your fund. You said you had an SMSF. You're looking to start a pension, so please check your trust deed for any specific rules or any specific requirements that apply to you. Okay, so I'll give you an example of that. A deed that I looked at not long ago required that the request from the member to start a pension be signed off on or be ratified, be agreed to by a majority of the fund trustees. I don't know why that wording was in this particular deed, but what it said was we couldn't necessarily have a pension started unless the majority of the trustees said you can. So just look for those sorts of things, any specific requirements. Then you would see other requirements set out by the SMSF deed, things like that a member would need to lodge that request to start a pension. That request would usually include things like a start date, how much the pension should be, either a specific amount or an unspecific amount. It might say my whole balance. Those member requests need to be in writing, essentially. It should set out the details of how often you want those pension payments made, the frequency of the payments, and also set out any detail of any reversionary beneficiary that you might want if you want your spouse to automatically receive your pension on your passing, or whether it's non-reversionary. Just they're the things that would usually be included in a member request to start a pension. Now, once that request has been lodged, the trustees would then resolve. They'd set out a minute to commence that the requested pension. Request to set out a resolution to commence that pension. So they're saying, yep, no worries, we'll commence the pension to be paid. Once that's done, the trustees then send back notice to the member asking for the pension to say, yep, no problems, your pension will commence as requested. Or if there are issues with that, what those changes might be. Now, this is where things get a little bit interesting. The laws around the commencement of pensions, especially when it comes to sort of SMSFs, suggests that you need to provide the person requesting the pension with a copy of the SMSF's PDS, the Product Disclosure Statement. A product disclosure statement essentially is an additional document that sets out specific issues relating to the financial product. And it is a requirement set out that you do this. That is quite often, the objective of that is to make sure the member knows what they're doing and what they're getting into. So a way of managing that is to say, hey, I'm the member requesting the pension. I'm also a trustee. I already have a copy of the current PDS. So some fund administrators would include in the member request to start a pension the comment that says, as a founding member or as a current member of the fund, I already have a copy of the PDS. Look, don't overlook this. It is a requirement. We don't want anything to come back and bite us later. It's just one of those older style rules that we do need to keep in mind. If you've got a fund administrator, just question that with them. Do I need that, and can you meet that objective for me? The next thing that we then need to look at is you've asked, what else do we need to do? Do we need to inform the ATO? And the answer is yes. If we're moving part of our accumulation balance into a retirement phase pension, so into one of those pensions where the earnings are tax-free, then we need to lodge a transfer balance account report. We need to lodge that with the ATO to say, hey, Mr. ATO, I've started a retirement phase income stream, and then they would include that, remember, in your transfer balance account that we looked at before, your personal transfer balance account. That's the way of informing the ATO that you've started a pension. You inform them by completing that transfer balance account report. Now, these reports need to be lodged on a quarterly basis with the ATO. So at the end of each quarter, so you've got essentially the July, August, September quarter, you need to lodge a report with the ATO for any event that occurred during that quarter by 28 days after the end. So for July, August, September quarter, you would need to lodge your transfer balance account report by the 28th of October. And then the next quarter would be October, November, December, which means you've got to lodge a report for any event which occurred in that quarter by the 28th of January, and so on and so on. So you need to lodge a transfer balance account report where an event occurred in that quarter. And those events were what we went through before: starting a pension, stopping a pension, and so on. Last point there, though, to keep in mind is that starting a transition to retirement pension is not a retirement phase income stream event. Transition to retirement pensions don't get that tax-free earnings. The balances don't count towards your transfer balance account. So you don't need to lodge a T-bar report for transition to retirement pensions. So they're the things you need to think about when informing the ATO. Now, again, there's a really good article which is updated about 9 or 10 months ago on the website called Starting an SMSF Pension Checklist, and it'll take you through all of those things, what you need to do around the specific steps to start a pension in your SMSF. So have a look at that one. There's some good information there. The next part of your question was around actuarial certificates. Okay, so I want to take you through this because there's two separate issues we need to address here. The first one is that you may need to get an actuarial certificate each and every financial year where your fund's paying a pension. So this isn't before you start a pension. This is the annual actuarial requirement. And what it does is it allows an independent assessment to take place by an actuarial provider, by an actuary, around how much of the fund's income relates to assets in tax-free pension phase and how much of the fund's income relates to income that's not in pension phase. So it's in retirement phase. And that calculation, that percentage, is then applied to the fund's overall income to work out how much tax the fund has to pay. So the actuarial certificate is used to calculate the amount of exempt current pension income that we get each year. We can't claim that tax-free income unless we have the actuarial certificate provided. Unless the whole fund's in pension phase, then we don't need to worry about an actuarial certificate. But I don't believe that's what you were asking in your initial question, Pavan. I think you were asking about what I need to do when a pension commences. Because, yeah, a lot of checklists do say on the commencement of pension, you might need an actuarial certificate. And that is in relation to older rules in years gone by where funds, SMSFs, were allowed to pay other types or other styles of pensions. And those pensions did require you to get an actuarial certificate before you started to make sure the fund could actually meet those pension obligations. So they were for other style pensions, things like your defined pension styles, not the existing pensions that SMSFs pay. They were more designed around older style pensions. And the rules essentially said is your fund can't start to pay you one of these other types of pensions unless you've got an actuary to sign off that you can meet that obligation. As of today, SMSFs are really only allowed to pay account-based pensions. So that pre-commencement actuarial certificate is no longer required. It's a rule from many years ago. Now, there is talk of a change in years to come where you might be able to pay other styles of pensions. So this might eventually come back in, but at the moment you probably don't need to worry too much about the need to obtain an actual certificate for those account-based pensions. All right, so again, some resources for you there. I gave you the checklist earlier. There's also articles on how to start pensions. And again, that webinar I referred to before about starting an account-based pension in an SMSF. So have a look again at the website. There's plenty of resources there for you.